Welcome back to our deep dive into the El Niño trade. In part 2, we move beyond the initial forecasts to the hard math of the convergence. We're looking at the shifting flaws of the global market. Here's the asymmetry, and it's the whole game. Every one of these crops has a cost of production flaw. Sugar costs roughly 9 to 10 cents a pound to grow. Below that, farmers stop selling. They'd lose money on every ton. So the downside isn't capped by a chart line. It's capped by economics. Bounded loss underneath, and a Super El Niño supply catalyst sitting on top like a free option. Small, defined risk down. Open-ended upside if the weather bites. But here's what almost no one's pricing yet. That floor isn't sitting still. It's rising. And the reason is happening 1,000 miles from any farm. The floor under these crops is the cost to grow them. And this year, that cost got a shock. Why? Fertilizer. Nitrogen fertilizer is made from natural gas, and the Gulf supplies about 1/3 of all the urea traded on Earth, most of it sailing out through one waterway, the Strait of Hormuz. When the Iran conflict shut that strait this spring, the fertilizer market seized up. Iran halted its ammonia, Qatar suspended urea production, and tanker traffic through the strait dropped by about 70%. Urea jumped to 3-year highs, up somewhere around 1/3 to 1/2 in a matter of weeks. And China was already holding its own exports back. So yes, for once in your life, the price of crap genuinely matters. Now, here's the honest update. There's a deal on the table right now to reopen the strait, but that does not unring this bell. The fertilizer for this growing season was bought or skipped while prices were spiking, and that cost is already in the ground. Think about what it does. Fertilizer is 20 to 35% of what it costs to grow a crop. So the cost floor lifts up. And farmers who cut back on fertilizer to save money, that cuts yields. A second supply hit, stacked right on top of the weather. The floor rises and the supply shrinks. Both directions at once. And the calendar means it sticks for this harvest, even as the headlines calm down. Here's an edge almost nobody talks about, and it costs nothing but attention. I read the Indian papers, not Reuters. Think about how information actually travels. A crop fails in a district in Maharashtra. The local reporter writes it up that day, in the local paper, in the local language. The State Weather Service posts the rainfall numbers. That's the source, raw, early, specific. Then it takes weeks for that to get translated, aggregated, simplified, and folded into a tidy international wire story that lands on every trader's screen at the same time. By the time it's a Reuters headline, it's old news with the texture sanded off, and the price has already started moving. So I skip the summary and go to the source. Right now, today, the Indian Meteorological Department shows June rainfall running 64% below normal. 19 millimeters against a normal of 54 because the westerly jet stream shifted south. That number is sitting in the local Indian press as we speak. It will be an international headline in about a month, and by then the easy part of the move is gone. The edge isn't being smarter. It's reading the source instead of the summary, and being early on purpose. Now the part no one else will tell you. I built a model to predict prices from the weather. It works beautifully. It predicts that I just wasted 3 weeks. Seriously, I tested it. Can I predict the price from a rain forecast? No. And here's the secret the whole industry hides. Almost everything is a null. Nearly every signal you'll ever be sold is noise dressed up as an edge. The weather to price link is no different. Contemporaneous, lagging, no clean lead. So I don't time it. Read that again. The structure I trade exists because the signal isn't predictive. If I could forecast the rain, I wouldn't need the floor. The floor is what protects me from being wrong. Honesty isn't a weakness here, it is the risk model. Now let me show you why I think that. Not with theory, with my own record. And I'm giving you this in good faith. Not as a boast, not as a tip, just so you keep your eyes open. I've been trading these markets for years, and a big chunk of it is on the record. Thousands of calls, time-stamped, made in public in trading groups as they happened. You could go back and check them. And here's what that record keeps saying. Roughly 80% of all my profit came from the top 20% of my trades. 20%. Strip those few out, the heroes, and everything left over barely breaks even. Sit with that because it's the most important number in this video. It means the day-to-day was mostly noise, small wins, small losses, scratches, cancelling each other out. The money did not come from being right a lot. It came from being positioned when the rare, violent, asymmetric move finally arrived, and then having the nerve to let it run. That's not luck, and it is definitely not prediction. It's structure. You can never know which setup turns into a hero. And let me be dead straight with you. None of this means I'll be right this time. I might be completely wrong on these softs. This is not me telling you to trade anything. It's me showing you what the setup looks like and what the AI and I are watching. So you can watch it too. Because here's the thing you can do. Make damn sure you're holding a cheap, flawed, stacked setup when the lottery draws its numbers. So that if a hero shows up, you're already in it. Almost everything is a null. The heroes carry the book. That's the whole game. Eyes open and let the structure do the work. So how do you actually hold this without blowing up? Small lots. A basket, not a single bet. Sugar, coffee, OJ, rice, spread out, so no one crop can hurt you. 1% of capital at risk, with a guaranteed stop. A roughly 6-month hold because the lag is slow. And a kill condition written down before I size it. If the mid-July monsoon recovers toward normal, the catalyst is deflating and I trim. 2022 is the cautionary tale. June opened in deficit, everyone turned bearish on the crop, and then July came in nearly 17% above normal and wiped the whole deficit out. By August, it was running above average. An early season deficit is not a decided trade. The number decides, never the story. Now stack it. In one trade, on one basket, at one moment, a Super El Niño that the science says is escalating, not reverting. 2 countries that control over 60% of the supply. A live sugar export ban and a rice ban precedent. A citrus disease quietly killing the orange crop. And a fertilizer shock out of the Strait of Hormuz that's lifting the cost floor while it cuts yields. Weather, geopolitics, disease, and policy. 4 independent supply shocks hitting the same cheap basket at the same time. This is what stacking factors looks like. I can't tell you it pays out, nobody can. But I can tell you the odds are leaning, hard, one way. I've watched this market for years, and you do not see this many forces line up on one side of the boat very often. That's not a prediction, it's a setup, and setups are the whole game. Almost everything is a null. A setup like this is what puts you in, and lets the lottery of life hand you a hero, so there it is. One driver, a Super El Niño that's getting stronger, not weaker. 2 countries on the switch, a disease, a failing monsoon, export bans, and a fertilizer shock lifting the floor while the weather cuts the supply. We didn't predict a single one of those. We just found them all leaning the same way and stacked them in our favor. That's the job. You don't forecast the future. You set up, you cap the downside, and you wait for the lottery of life to pay out a hero. Most of the time it's a null. Sometimes it's a monster. We track the local press. We wrote the exit before the entry, and now we watch it, fail or pay, in public, in real time, against the Indian papers. Follow along. This is the way. If you found this useful, hit like, subscribe, and leave a comment for more.